Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. So we've said it's possible to beat the markets. We've said it's possible to time the markets. I don't want to say it's easy, but relatively easy way to time the markets is to wait for the fat pitch and avoid a bad situation. So Ritger, are we in one or either of those situations right now?
We've got a very expensive market right now, and things are going to go badly in the next few years from here. So yeah, this is a time where you want to raise cash, get safe, and wait for that fat pitch.
What makes you say that? Why now?
Well, long-term market timing that bull-bear cycle that takes a decade to play out, from a round trip takes a decade. That's it's pretty straightforward. You use valuation. It's the most reliable way to time the market over the long term, which is the only term that really matters for most people. So you look at things like you keep it really simple. When you're looking at the market as a whole, just take the S&P 500 and you look at its price to sales ratio, you look at its normalized PE ratio, meaning a moving average of earnings. You look at the Tobin's Q, which is, it's basically price to book, or the ratio of the market cap of all US stocks to GDP, something like that. They all agree, they all will tell you the same thing at any point in history. And right now they're all saying that this is a ridiculously overvalued market. This is on par with 1929 and 1999. Doesn't mean it can't get crazier, but this is not a good time to be long stocks.
So I don't disagree with you, and I'm starting to get nervous about it too. The thing about valuation though is that's what we could have said last year or the prior year. It's been an overvalued market for a couple years, and on a personal basis, I'm personally okay with sitting out of markets and waiting for that fat pitch. But it's tough for money managers to do and justify to their clients sitting in cash. And you can be wrong for a few years. You alluded to John Hussman in the last episode, and he's been someone who has a pretty good valuation methodology, and he's been, I think, like you said, taking a lot of flack for being out of the markets, and now he gets labeled a perma bear.
That's right. That's an unfair label in my point of view. The guy was long in the 90s. He got out near the top of that bear market. He got back in when stocks got cheap in the early 2000s, and he got out again in 2007. I credit him and a handful of other people, but above all, Hussman, with teaching me market valuation just in time to get out of that market and actually short that market.
So you're talking about the 2007,
2008 crash, yeah. I got bearish by increments starting in about 2006. And it was, first I got a bit nervous, started putting on some hedges of things I couldn't sell, like private stock positions. And as things developed, I began to understand what was happening in the credit markets and the real estate market. And so that little hedge became an outright short, a big leverage short by the time we actually went into it. So it all worked out in my case, though. That's not anything I would recommend anybody try.
Well, you were a young man then.
I was 20-something years old, yeah.
So we got this market that's been overvalued for a couple of years. You told me, I think maybe a couple weeks back, 2-3 weeks back, you were getting to the point where you were having trouble sleeping at night with the markets. And I said, Ricker, what are you having trouble sleeping for? The momentum will tell us when to get out. But I recently just joined you in the bearish camp. I got to the point where I couldn't sleep at night either. And what happened to me was there were a lot of problems already in the market. Valuation was a problem. The leadership started becoming very thin. So you knew it was going to end badly. I took action this week because I started to see things, bubbles popping. Now, the human mind tends to form patterns sometimes when patterns don't exist, but I believe that things pop in clusters. So in the 2007 crash, or the prelude to the financial crisis, I don't know if you remember. I mean, I'm sure you remember well, but there was a market sell-off in February, and that was like a little bit of a hint. And then the Bear Stearns real estate fund blew up in the summer of 2007, and they called it, oh, it's limited, it's an isolated event. Same, if you go back to '98, the Asia crisis was an isolated event. All these things are isolated, and then it's sort of a contagion that builds. So in my mind, you've seen some certain things pop. And one of the set areas of focus of this speculation or this optimism is the tech world. And what the Qs did last Friday, to me, was a scary sign. We'll see if it evolves into something more, but to me, combined with maybe we're entering a seasonal period, this May to October period isn't a great time historically to be into markets.
Sell in May and go away.
Sell in May and go away. And then how much more upside are you really giving up getting out of this market?
Yeah, who knows how much more upside there is, because these final blow-offs can go vertical. You saw it in 1999. I wasn't in that market, but you made money in that market.
And lost half.
Yeah, we know with absolute certainty that whatever money is made from here forward, whatever money has been made from, say, 2013, 14 forward, will be given back ultimately, because we've been overvalued for a long time, and now things are just stretched to such an extreme that it didn't feel prudent to stay so heavily allocated to stocks, even in strategies that get out when things start to fall. So the way we trade momentum. So we'll generally be agnostic about valuation. That's its strength. It allows you to make money in a market that's overvalued. So long as it keeps going up, you can stay in it because you're not going to ride it down. Something might be so expensive that it's going to fall ultimately by 75%, say, but you ride it up from overvalued to more overvalued to crazy overvalued, and then you give back some, but you're not going to lose 75% because that doesn't happen all at once. That'll play out over a year, 2, 3, 4, 10 years. So momentum is wonderful like that, but it's, depending on the type of account that you have that you're managing. We're managing retirement accounts in a lot of cases. It doesn't feel prudent to stay whole hog. Now it's not like we've made we haven't cut exposure 100%, but we did scale back significantly. Because what are you giving up really, and what's the trade-off for that?
So one could have made the bear case in 2013, one could have made the bear case in 2014, one could have made the bear case in 2015. We're 2016. There were some prominent people that came out each year saying that this is it. I think we had a slew of people coming out, a couple in the last week or two, Jim Rogers and Bill Gross, and last year there was Jeffrey Gundlach and Soros, I think, or Druckenmiller. I don't remember all the names, but prominent, respectable people around this time saying the valuation is a problem. It's not going to end well. We're finally saying we're getting uncomfortable with the market. When would you say you're wrong?
All right. Well, let me say that. Let me reiterate that valuation is not a precise timing tool. I would not use it to short the markets. And I would not put a high degree of confidence on being right about your timing. An overvalued market can get more overvalued. An overvalued market can stay overvalued for a long time. What Keynes said, that the market can stay irrational longer than you can stay solvent. So ultimately, all these guys will be right. If you're a buy and hold investor, it's more important to get out early, to be more prudent, because you don't have that luxury of just whacking out on technicals the way a momentum investor can.
A lot of people belittle the people that believe that you can time the markets. the way I look at it is that we're 8 years into a bull market.
Yeah.
And a bear market is coming. The way the moon follows the sun or the sun follows the moon, bear markets follow bull markets. So I think it's crazy not to attempt to not get hurt in the bear market. I think it's a crazy notion to just say buy and hold through a bear market.
Yeah, and it's not just, you mentioned opportunity in the beginning. So a bear market is a huge opportunity. A cheap stock market is like the greatest thing in the world. It allows you to because all you have to do is buy and hold on. Stocks are a wonderful asset class. Ownership in mature, efficient corporations is really rewarding over time. You can just buy stocks and put them away if you buy them right. But you've got to have the cash to do that. And if you don't get liquid when stocks are expensive, you can't take advantage of that opportunity. So you could say it's prudence, but it's also greed. It's long-term greed.
And a little bit of wanting to, that's the thing you have to be scared of, is the internal wanting to be right. Or I think that's the seduction on the short side, is that you get to be right when everybody else is wrong.
That's the biggest trade in my life, right? I made what was a lot of money for me at the time in that last bear market. And bear markets can make you money if you're right. They can make you money a lot faster than bull markets because they happen faster. That market dropped from 2007 to, from late 2007 to late 2008, early 2009, the market retraced 12 years of history. It went back to a 1996 valuation, just like that.
That's right.
Nobody thought it could happen. I was absolutely positive that it was going to happen. And I was pounding the table for it long in advance. And when it all happened, it didn't feel all that great. Okay, I made money. I felt vindicated. I felt smart, but it wasn't. It's not. It was exciting, yeah, but it's a bad time. I mean, bear markets hurt people.
That's the truth.
And this one is going to hurt people more than the last one.
Why do you think that?
It's an older country. Just that alone.
That's true.
It's an older country. The baby boomers, our biggest cohort right now, are just entering retirement or just about to retire. By and large, they haven't saved all that much. Most of them don't have enough as is, or they have just enough. Very few people have huge nest eggs. And I just saw a chart today. The older somebody is, or the older an American is, the more they're going to have as a fraction of their net worth in stocks, even given wealth. It was for households with 100,000 or more in liquid wealth. Millennial households, guys in their 30s, couples in their 30s, it was 70% cash and only a small fraction in stocks. Whereas it was like flipped for the silent generation, people in their 80s, and then baby boomers had just a little less in stocks. So they're real true believers. It's
a byproduct of what they've seen in their life. Stocks work for them, and the newest group of investors, the 20, 30-year-olds, they don't have faith in anything.
Yeah, it depends. It's a byproduct of when they came of age. The baby boomers started saving in what was a really cheap market, late 70s, early 80s. You started investing then, you did great.
I'm nervous on two fronts also. One is I think people are going to get hurt because, people are going to get hurt in general in bear markets. The other reason I'm nervous is the age thing, meaning I hear and see 60, 70-year-old people blindly believing stocks are going to go up forever. That's scary. And then I don't know how much cushion people have. We've had some pretty rough markets in the last 17 years. And people haven't traded it perfectly. I mean, by nature of markets, most people have been losers.
I saw this chart again just today. The long-term performance of an individual, your average individual investor, lags the S&P by 4% a year, which takes you from 6% real returns, that's a nice return over a lifetime, to 2%, which is like barely better than a savings account.
So this is a good segue into, so got this view where it's time to be nervous about markets. Mm-hmm. It's time to avoid a bad situation. What are some other ways to approach it, or specifically how should somebody approach the market on a going forward basis?
Well, all right. I don't think we ever answered your original question of how do we know if we're wrong. I know that I'm not wrong. I mean, there's no more reliable. If you're using valuation and you're not trying to get too precise about it, this is just, it's the right call, and will be ultimately.
You have to bet on something. Price to sales is at 2 something, and historically it's at 0.9. So
that's right.
Stocks have to get way more expensive than they've ever been. The fundamental bull argument would be that, well, earnings can grow, but heard
they
this. They haven't been. So I haven't verified this, but I've heard that this. If you take out a Facebook, revenue growth has been declining the last 8 years for the rest of the S&P 500.
Yeah, the S&P revenues have barely changed for the last decade.
So the only way that stocks can go up from here is the bigger fool.
Yeah, because margins aren't going to expand. Margins are high. So the bottom line is it can only come down from here.
So I'm with you when you say you're not wrong. It's hard thing for people to understand that, though.
You can't interpret this as we're timing the market, yes, but we're not saying this week this is the top. Maybe it is, maybe it's not. It's probably not. The odds of that are pretty slim. The market's probably going to go on. I mean, momentum is still there. Market looking at a chart. If I were completely ignorant of valuations, just looking at this chart, it's a market that's marching up pretty steadily. It's got good momentum.
So this is maybe the way to answer the question. Mm-hmm. You have to know it's a bad bet.
It's a bad bet.
So, and you can leave it there, and that we know it's a bad bet. Mm-hmm. The timing may be wrong. I'll say my timing is wrong on it, and I don't know if you act on that timing or not, but the timing will be wrong. I'd say if the NASDAQ, which looks like it might have made a top, maybe if it starts making new highs, then the timing is going to be delayed to some future date. I mean, it could be in a few months or what.
Yeah, you told me before that you would consider yourself wrong if the NASDAQ makes a new high. And I think that's crazy, because the NASDAQ could make a new high tomorrow.
Well, I won't say I'm wrong. I'm saying the timing is, in the world of traders, if you're not right at the right time, you're wrong.
I'd say if you're using valuation, you gotta give yourself a little more leeway.
Okay, so now what should people do armed with this?
You got to sit tight. You got to sit tight. If you make a call like this, you can't just jump right back in because you read some article or you just change your mind. No,
you have to have some conviction.
You got to have conviction. Do your homework. Look at those long-term valuation metrics. Everybody should be aware of how to value the market as a whole. It's not hard. And then sit tight. Wait for the market to come back to you. Wait for that fat pitch. You want that price to sales ratio to come back to some middle level at least. Back in the realm of not crazy. You want the Shiller PE to come back from 30 towards 20, if not under 20. The long-term average is 15, 16. So you got to wait for the valuations to retreat before you step back in whole hog. Things can go from decently valued to super cheap. That's a whole other discussion. But if you're getting out because things are expensive, wait until they are no longer really expensive before you get in. It's as simple as that. It might take a long time. It might be frustrating. Maybe the market, goes up for the rest of this year and, your idiot neighbor is making money. That's the price you pay for winning in the long run, being different.
If you want different results, you got to do things differently. Mm-hmm. So, if I'm hearing you right, the simplest thing that anybody can do is sell, have some cash, have some dry powder when the other side of the coin makes itself available, which is the fat pitches.
Yep.
So we're avoiding the bad situation by selling the risky stuff, which is in the asset class world, equities, and having some dry powder available when it's available. What do you think about other things like shorting and things like you did in 2007, 2008 market?
If you're young, you got income, you got a high risk tolerance.
I'll add one other thing.
And you've done your homework.
I'll add one other thing. The short side's a tough market. I would say you have to have some experience trading it, and if you haven't had experience, then maybe take a very small fraction if you want to get the experience. But it's a tough trading the short side's even a tough proposition for professional traders.
There are a lot of bad ways to short. Trading the short side in the long run, of course, is a losing proposition because in the long run, stocks go up. So you got to be precisely right to make money shorting. But the odds are as good as they get from a valuation point of view. I would just wait for the technicals to line up, wait for this market to chop sideways for a while, and then start to roll over. Wait for it to cross underneath its 8, 10, 12-month moving average. If it does that, then the near-term prospects, meaning the next year or so, will be highly negative. Once an expensive market has bad technicals, that's the very worst combination.
Right.
Right now we just have a very expensive market and kind of, the technicals are they're not as good as they were a few months ago, but shorting's tough. Don't use an inverse ETF. Whatever you do, those things are a disaster. There are a lot of ways to be.
You're going to be a trader for a lot of those things, which people don't realize. They made these inverse ETFs so IRA accounts can participate on the short side because IRAs can only be long, retirement accounts you can only be long securities.
Yeah.
But the way it works is they basically reset every day, and so
the market can go sideways and you can lose money in an inverse ETF.
Things can go down and you can lose money in an inverse ETF.
If they don't play out exactly right, you're going to lose money in one of those. The cleanest way to do it is with futures. But futures trading allows for a lot of leverage. So don't max out your your margin with futures. But it is the cleanest way to do it. Just sell a futures contract and then roll it over. So buying put options, you can define how much you can lose, though you have to expect to lose it all. Selling calls is a better proposition, though you can get yourself into trouble there just with futures. There's unlimited loss there if the market goes higher. Shorting's not easy.
Shorting's not easy. So the simplest thing that anybody can do is maybe get some cash, get some dry powder, and wait for better opportunities. We're approaching time, but we do have a question, and it pertains to our discussion today. The viewer asked, do you have an opinion on using the VIX to hedge stock exposure?
That's a good question. It's a pretty sophisticated way to hedge exposure. It's not the way I would do it. Number one, I'd say, why are you trying to hedge your position? Why not just sell it outright? Capital gains taxes are 20% max. Stocks can fall 20% in 2 weeks once we enter a bear market. Hedges are expensive. No matter what hedge you choose, there's a cost to it in holding that hedge. If the market goes higher, goes sideways, doesn't fall as much as you think it's going to fall. Hedges take work. You have to monitor them. You have to do them just right. You've really got to be an experienced trader to do hedges right. There's nothing wrong with just selling, raising the cash. But if you can't sell, if you have like a private stock position, if this is stock in your employer, if this is say stock options, something that you can't just sell outright right now for some reason, then I would hedge it as directly as possible. If it's a particular stock position, hedge that stock. Buy puts on that stock, start selling calls, buying puts on that. But again, options are really tricky.
I like your point, though, is you want to, people come up with these convoluted ways to solve their problems.
Yeah.
And it's good to ask yourself, why are you coming with this convoluted way to solve the problem? Why not just get right to the issue? If you want to why do you want to hedge your stock exposure? If you want to reduce your stock exposure, reduce it. Because hedging comes at a cost, and it comes at requiring skills that you may or may not have.
Yeah.
And then the problem with the VIX in particular is you're really trading volatility.
It's a very different thing than trading stocks. Stocks, volatility doesn't move one-to-one with stocks. And
well, I think that's the attraction, is the volatility explodes when stocks fall. But that's the other thing, the way the stock falls matters.
Yeah.
It's not just if it trickles down, I don't think you'll make anything with your VIX exposure. But if it has to, now the nature of things falling, it tends to collapse, and the VIX tends to spike. Mm-hmm. And that's another notion, is you can't really trade the VIX. It's a mathematical construct. You have to trade VIX futures.
That's right.
And so this, say talk about ETFs, but those volatility ETFs are really problematic, because you have the VIX spot, which say trades at 10.5 and 11, and the VIX futures, which trades at 15. So you buy the VIX futures, it deteriorates to 11, and then it rolls over, and then you buy it at 15, and it just keeps deteriorating, and that leakage comes out.
That leakage is going to add up to be more than the taxes you would pay for selling the position.
Right.
Avoiding taxes is really generally making decisions to avoid, doing something just to avoid taxes is generally a bad idea.
It's a very, people get seduced by that idea easily.
Yeah,
but
people hate taxes. They think they're coming out, they're pulling a fast one on the government, but it's not the right way to play.
Yeah, I mean, aside from the whatever your political feelings on taxes are, it's not the right way to play in a practical way.
It's not efficient. No, it's not.
It's not efficient. That's the.
Yeah, if you could
deal with it second. Make the good decision. Make the good decision, and let the chips fall where they may with the taxes.
Exactly.
Don't let the tail wag the dog, so to speak.
Exactly. Because then you've got this whole other decision of when to unwind your hedge, and then you got to pay taxes on the profits from your hedge. And those are going to be short-term gains, probably.
That's right. So we're probably over time. So anything you'd like to leave with for our viewers?
I think that's it. Think about if you're selling, and you should be selling. Think about the opportunity ahead. It's not about being super conservative. It's not that boring, because what's about to happen will be exciting, and there'll be exciting opportunities.
That's the appeal to the young man or young person. I think the I don't want to call it a plea, but
that's the greed appeal.
That's the greed appeal. The fear. I want to call it the fear appeal, but there's something to be said to be prudent and not being greedy.
Yeah.
I think why do people remain in stocks at these, if you knew what the valuations are? Because you're greedy, you want more, or because you're scared to be alone.
You don't have the courage.
You don't have the
conviction, you have the knowledge, the conviction, and by definition, everybody's in stocks just when they shouldn't be. Nobody was in stocks in March 2009. That was the all-time low in sentiment. Everybody thought they would keep falling. Why? Because they had just fallen. They've just gone up a lot. Everybody thinks they're going to keep going up. Happens every time.
Bold call, Ritger. We say we can time the markets, and we're saying, hey, this is a time you may want to think about timing the markets.
That's right. You got to win by being different.
Thanks for watching.
See you next time. Don't forget to like and subscribe.
And share. Thank you.